In the pantheon of financial warnings, few signals carry the weight of billionaires quietly liquidating their empires. These are not impulsive actors prone to panic. They are the architects of modern American capitalism, individuals who have demonstrated across decades an almost preternatural ability to see around corners, to sense when the music is about to stop. And right now, in late 2024 and throughout 2025, they are selling, not trimming positions, not rebalancing portfolios, selling with a conviction and scale that echoes the final acts before previous market catastrophes. Warren Buffett, the man who built a trillion-dollar conglomerate by buying when others sold and holding when others panicked, has dumped over $134 billion in stocks during 2024 alone. Let that figure settle in your mind. More than $100 billion. His company, Berkshire Hathaway, now sits atop a cash fortress exceeding $334 billion. This is not diversification. This is not portfolio management. This is preparation for something fundamental. Something Buffett sees that the jubilant crowds pouring money into markets at all-time highs evidently do not. The Oracle of Omaha is hardly alone. Jeff Bezos, who built Amazon into a colossus that redefined retail and cloud computing, liquidated $8 billion of his own company's stock in a single month. Mark Zuckerberg, architect of the social media age, sold nearly $500 million worth of Meta shares. Jamie Dimon, the CEO of America's largest bank and a man who sits at the nexus of global finance, sold stock for the first time in his entire tenure leading J.P. Morgan Chase. These are not the actions of nervous amateurs checking their brokerage apps. These are surgical strikes executed by individuals with access to information, analysis, and insight that dwarfs anything available to ordinary investors. As a financial historian who has spent decades studying market cycles, speculative manias, and the behavioral patterns that precede every major market dislocation, I can tell you this: the current moment rhymes with periods that ended very badly for those who ignored the warnings. Not perfectly, mind you. History never repeats exactly. But it rhymes in a way that should make anyone holding stocks at current valuations profoundly uncomfortable. Consider what these billionaires are observing. The Standard & Poor's 500 index, the benchmark of American corporate prosperity, now trades at a price-to-earnings ratio north of 30. For those unfamiliar with this metric, it essentially tells you how many dollars you must pay for each dollar of corporate earnings. At 30, you're paying $30 for every dollar of annual profit. This is expensive. Historically, extraordinarily expensive. In the entire modern era of American markets, this ratio has exceeded 30 only during one sustained period, the dot-com bubble of the late 1990s and early 2000s. We all remember how that ended. 7 years of losses. Trillions in wealth evaporated, retirement dreams shattered. And yet here we stand again, with markets at virtually identical valuation levels and the crowd cheering for more. The cyclically adjusted price-earnings ratio, a more sophisticated measure that smooths out short-term distortions by averaging a decade of inflation-adjusted earnings, tells an even more disturbing story. This ratio currently stands at approximately 34, against a historical average since 1871 of just 17. Think about that timeline. 150 years of American capitalism, through wars and depressions, through Gilded Ages and progressive eras, through the rise of railroads and the birth of the internet. Across all that tumultuous history, stocks have averaged a valuation of 17 times earnings. Today we sit at 34. That represents an overvaluation of roughly 110% above the long-term mean. Now, some will argue that higher valuations are justified by new technology, by artificial intelligence, by productivity gains, by any number of narratives that sound plausible until markets actually correct. I have heard these arguments before. I heard them in 1999 when people insisted the internet changed everything and old valuation metrics no longer applied. I heard them in 2007 when sophisticated financial engineers promised that complex derivatives had eliminated systemic risk. The narrative always sounds convincing at the peak. It must, or the peak would never form, but the mathematics of valuation are cold and unforgiving. When you pay $30 for $1 of earnings, your expected future returns plummet. The arithmetic is not optional. Berkshire Hathaway's selling provides a masterclass in how to read market conditions. Buffett didn't just reduce his Apple position modestly, he sold over 600 million shares of the company during 2024. Apple was not merely a holding, it was his largest position, a bet that had made Berkshire shareholders vast fortunes as the iPhone maker became the most valuable company on earth. To sell that much of your best investment, you must have profound concerns about either that specific company or the broader market environment. Given that Buffett has repeatedly praised Apple's business quality, the conclusion seems clear. He believes the market itself has reached dangerous territory. The cash accumulation tells an equally important story. $334 billion earning interest in Treasury bills. Some quick mathematics reveal the brilliance of this positioning. With short-term interest rates around 4 to 5%, Berkshire now generates somewhere between $13 and $17 billion annually just from interest income, risk-free. That exceeds the entire annual profit of most Fortune 500 companies. More importantly, it provides enormous firepower to deploy when markets inevitably correct and genuine bargains emerge. Buffett famously acquired some of his best investments during moments of maximum panic. American Express during the salad oil scandal, Goldman Sachs and General Electric during the 2008 financial crisis, Bank of America when it teetered near collapse. He is preparing to do it again. But Buffett's behavior becomes even more telling when you examine what he is not doing. Berkshire repurchased less than $350 million of its own stock in the second quarter of 2024. This represents a dramatic decline from the $2 billion repurchased in each of the prior quarters. The company's policy explicitly states it will buy back stock when Buffett believes the price sits below intrinsic value, conservatively determined. The implication is stark. Even his own stock, even Berkshire Hathaway trading at a market capitalization exceeding $1 trillion, looks expensive to him. When Warren Buffett won't buy Warren Buffett, you should pay attention. The valuation problem extends far beyond simple price-to-earnings ratios. Consider what happens when markets trade at 30 times earnings. The earnings yield, the inverse of the price-earnings ratio, stands at approximately 3.3%. This represents what you earn from dividends, buybacks, and retained earnings for each dollar invested. Add in expected inflation of around 2 to 2.5%, and your projected total annual return barely exceeds 5 to 6%. This might sound acceptable until you realize that 10-year Treasury bonds, backed by the full faith and credit of the United States government and carrying essentially zero risk, currently yield over 4%. Stocks are offering investors a risk premium of barely 1.5 percentage points. Historically, equity investors have demanded much larger premiums to compensate for the volatility and risk inherent in stock ownership. When that premium shrinks to current levels, expected returns disappoint. The fiscal dimension of the current crisis adds another layer of concern that sophisticated investors clearly recognize. The United States government now carries nearly $29 trillion in debt held by the public, representing 99% of the entire economy's annual output. The federal deficit for fiscal 2024 reached $1.8 trillion, marking the fifth consecutive year of deficits exceeding $1 trillion. Even more alarmingly, this occurred during a period of sustained low unemployment and solid economic growth. Historically, deficits decline during good economic times as tax revenues rise and spending on social programs falls. The fact that deficits remain catastrophically high despite favorable conditions reveals a structural imbalance that will not correct itself. The cost of servicing this debt has exploded. Net interest payments reached $882 billion in 2024, growing by 34% in a single year. The government now spends more on interest payments than on national defense, more than on Medicaid, more than on programs for children. As a financial historian, I can tell you this is unprecedented in peacetime. Previous periods when interest consumed such a large share of federal spending preceded either dramatic fiscal adjustments through tax increases and spending cuts, or sovereign debt crises that destroyed currency values and impoverished populations. Neither outcome proves favorable for stock market returns. Buffett has hinted that expectations of higher capital gains taxes motivated some of his selling. This reflects clear-eyed realism about fiscal mathematics. With debt exploding and interest costs spiraling, the government faces stark choices: raise taxes, cut spending, or continue borrowing until a crisis forces adjustment. Political economy suggests that tax increases on capital gains represent the path of least resistance. Current capital gains rates sit at 20% for top earners, plus a 3.8% net investment income tax. These rates, historically speaking, remain relatively low. During the 1970s, capital gains rates reached 35%. In the immediate post-war era, they occasionally exceeded 40%. Sophisticated investors recognize that current rates cannot persist given fiscal realities, and they are harvesting gains now before the inevitable ratcheting upward. The selling has extended well beyond Buffett's Omaha headquarters. Across the spectrum of billionaire investors and hedge fund managers, a pattern of aggressive liquidation has emerged. Stanley Druckenmiller, whose Duquesne family office has generated legendary returns over decades, completely exited his position in Nvidia after building it in late 2022. Israel Englander's Millennium Management has slashed positions in both Nvidia and Palantir Technologies by massive percentages. Jeff Yass, whose Susquehanna International represents one of the most sophisticated quantitative trading operations on the planet, has similarly reduced exposure to these high-flying technology names. The pattern becomes more striking when you recognize what these investors are selling. The best-performing stocks of the past 2 years, companies at the forefront of the artificial intelligence revolution, businesses that have driven virtually all of the market's gains. These are not failing enterprises or troubled industries. They are the market darlings, the stocks that everyone wants to own, the names that dominate financial media headlines. When the smartest money in the world sells what everyone else desperately wants to buy, you should pause and consider what they see that the crowd misses. The artificial intelligence phenomenon particularly concerns students of financial history. We have witnessed this movie before, many times. Revolutionary technology emerges. Early adopters profit enormously. Excitement builds. Narratives develop about how this innovation will transform everything. Valuations detach from any reasonable assessment of near-term profitability. More investors pile in, desperate not to miss the opportunity. Prices accelerate, and then, inevitably, reality intrudes. The technology often does prove transformative, but the path involves far more competition, far longer time frames, and far lower profit margins than the peak bubble valuations assumed. The internet unquestionably revolutionized human civilization. Yet investors who bought internet stocks at 1999 to 2000 valuations suffered catastrophic losses. Most of the companies failed entirely. Even the survivors like Amazon and Cisco took over a decade to recover their previous peaks, meaning investors endured negative returns for more than 10 years despite owning genuinely great businesses. The lesson is not that transformative technology fails to matter. The lesson is that paying absurd prices for even great businesses at the peak of speculative mania destroys wealth. Current concerns about artificial intelligence stocks extend beyond simple valuation. Competition in the semiconductor space that powers AI is intensifying dramatically. Nvidia may dominate today, but its largest customers are actively developing their own chips to reduce dependence on external suppliers. Microsoft, Amazon, Google, and Meta are all investing billions in custom silicon. Externally, AMD, Intel, and a host of startups are targeting the same market with increasingly capable alternatives. In technology, dominant positions rarely last. IBM dominated mainframes until mini-computers disrupted them. Microsoft dominated personal computers until mobile displaced them. Cisco dominated networking until commodity hardware and software-defined networking eroded margins. The cycle repeats with numbing regularity. Yet each generation of investors believes this time will be different. Chief financial officers at America's largest corporations, the individuals actually running businesses rather than speculating on them, share the billionaires' pessimism. A majority now predict recession in the second half of 2025. 75% describe themselves as pessimistic about economic conditions. 95% report that policy uncertainty impairs their ability to make business decisions. These are not professional doomsayers or market timers. These are operators allocating capital, hiring workers, and managing supply chains. When 3/4 of them turn pessimistic simultaneously, it reflects genuine deterioration in business conditions. The labor market has begun flashing warning signals that recession watchers recognize from previous cycles. Job growth has decelerated markedly. More concerning, revisions to previous employment data have repeatedly adjusted reported figures downward, sometimes dramatically. Government statisticians initially report strong job creation numbers that generate optimistic headlines, then quietly revise them downward months later when fewer people pay attention. This pattern of overstating job growth in real time followed by downward revisions characterized the period leading into the 2008 financial crisis. When you cannot trust the employment data, you cannot assess economic health accurately, and uncertainty breeds caution. Trade policy has emerged as a wild card that could accelerate economic deterioration. Tariffs, which function as taxes on consumers and businesses, have expanded significantly. 90% of corporate CFOs believe these tariffs will reignite inflation, forcing the Federal Reserve to maintain higher interest rates longer than markets currently expect. Higher rates strain corporate borrowers, particularly those with floating rate debt or maturing fixed rate obligations that must be refinanced at elevated yields. Margins compress. Investment spending declines. Hiring slows. The doom loop begins. Yet perhaps the most profound concern visible in billionaire behavior involves recognition that American fiscal policy has entered genuinely uncharted territory with potentially catastrophic consequences. The Government Accountability Office now projects that, under current policies, federal debt will reach 200% of GDP by 2047. Let me repeat that. Within a generation, the United States government will owe twice the entire annual economic output of the nation. No major developed economy has sustained such debt levels outside of wartime without either inflating away the obligations through currency debasement or defaulting outright. The historical precedents are not encouraging. Britain emerged from World War II with debt exceeding 200% of GDP. The government inflated it away over subsequent decades through policies that destroyed the pound's purchasing power and impoverished savers. Japan has carried debt exceeding 200% of GDP for years, resulting in 3 decades of economic stagnation, zero interest rates, and deflation that hollowed out the middle class. Neither outcome would prove favorable for American equity investors who assume that past returns predict future results. Some argue that concerns about government debt are overblown because the United States borrows in its own currency and can theoretically print money to service obligations. This argument contains a kernel of truth but misses the larger point. Yes, the United States cannot default in the technical sense that Greece or Argentina might default on foreign currency debt. But printing money to service unsustainable debts leads inexorably to currency debasement and inflation that destroys purchasing power. Bond investors demand higher yields to compensate for inflation risk. Higher yields increase the cost of servicing the debt. A vicious cycle emerges that ends either in draconian austerity or hyperinflation. Neither proves compatible with strong equity returns. Medicare and Social Security, the programs that provide healthcare and retirement security for tens of millions of Americans, face their own impending crises. Both programs' trust funds are projected to deplete within the next decade. When depletion occurs, benefits automatically get cut unless Congress intervenes. Medicare would face an 11% reduction. Social Security beneficiaries would see a 21% cut. Politically, such cuts seem unthinkable, meaning Congress will likely maintain benefits through general revenue funding, further exploding deficits. Alternatively, Congress might raise payroll taxes substantially, suppressing economic growth. Either path leads to worse outcomes for investors. The demographic mathematics driving these crises admit no easy solutions. The American population is aging rapidly as baby boomers move into retirement en masse. The ratio of workers paying into Social Security and Medicare versus retirees drawing benefits continues deteriorating. Immigration, which previously helped balance these ratios by expanding the working age population, faces political restrictions. Productivity growth, which might allow fewer workers to support more retirees through higher output per capita, has disappointed for decades despite technological advances. The combination of demographics, politics, and economics creates a nearly insoluble problem that will constrain American prosperity for years to come. Against this backdrop of valuation extremes, fiscal deterioration, recession risks, and demographic decline, billionaire investors are making rational choices to preserve capital rather than chase returns. They recognize that the mathematics of compounding works brutally in reverse when markets decline from elevated valuations. A 50% decline requires a 100% gain just to break even. Time and opportunity cost represent real wealth destroyed, not merely paper losses. The billionaires would rather earn 4 to 5% risk-free in cash and treasury bills while waiting for genuine opportunities than suffer catastrophic losses chasing the final increments of an exhausted bull market. History teaches that market cycles inevitably turn. Bull markets, no matter how powerful or extended, eventually give way to bears. Valuations that reach extremes return to means. Speculation that detaches from fundamentals reconnects violently. The billionaires are not trying to time the exact peak. They recognize that timing precision is impossible. Instead, they are responding to the accumulation of risks that collectively suggest poor risk-adjusted returns lie ahead. When valuation risk combines with fiscal risk, economic risk, geopolitical risk, and policy risk, the prudent course involves reducing exposure and preserving capital. Some investors will argue that attempting to avoid market declines through defensive positioning inevitably means missing some upside if markets continue rising before eventually correcting. This argument has validity. Markets can remain overvalued longer than seems rational. Bubbles can inflate further before popping, but this misses the critical asymmetry in outcomes. Missing the final 20% of a bull market while preserving capital for the subsequent bear market and recovery produces far superior long-term results than riding the full cycle up and down. The mathematics of losses requiring ever larger gains to recover from drawdowns means that avoiding large losses matters more than capturing all potential gains. Moreover, the billionaires are not entirely exiting markets. They are rotating capital into less overvalued segments, into international markets trading at much lower valuations, into defensive sectors that tend to hold up better during economic stress, into commodities and precious metals that historically protect purchasing power during fiscal crises. They are moving from offense to defense, from speculation to preservation, from chasing performance to protecting wealth. This represents prudent risk management, not market timing or panic. The contrast between current billionaire behavior and the actions of ordinary investors could not be starker. While the smart money sells, retail investors continue pouring record sums into equity mutual funds and exchange-traded funds. Individual investors, looking at recent returns and hearing narratives about artificial intelligence and technological transformation, are buying aggressively at the peak. This too echoes previous market tops. In 1999, individual investors bought technology stocks with abandon just before the crash. In 2007, ordinary Americans took out home equity loans to buy real estate investment trusts just before the financial crisis. In 2021, retail traders piled into meme stocks and cryptocurrency at the peak of that bubble. The pattern repeats because human psychology remains constant. Greed and fear, hope and panic, the desire to believe this time is different. These forces have driven market cycles for centuries and continue today. As a financial historian, I recognize that we stand at a particular moment in a larger cycle that has played out many times across American and global markets. The sequence is familiar. Easy monetary policy following a crisis inflates asset prices. Initial gains attract more investors. Rising prices validate the bullish narrative, attracting still more capital. Valuations detach from fundamentals as excitement overwhelms analysis. Skeptics get dismissed as perpetually bearish or unable to understand the new paradigm. The smartest investors begin quietly reducing positions. Then, almost imperceptibly at first, conditions deteriorate. Credit tightens, economic data disappoints, corporate earnings fall short of expectations, the market rolls over. Initial declines get dismissed as buying opportunities, but selling accelerates. Panic eventually sets in, losses mount. The cycle completes, washing away the excess, purging the speculation, and creating the conditions for the next cycle to begin. We are late in this particular cycle. The billionaires recognize this and are acting accordingly. They see valuations that have reached extremes previously associated with poor subsequent returns. They see fiscal dynamics that require either growth-destroying tax increases or currency-destroying monetary expansion. They see economic data softening despite official optimism. They see artificial intelligence enthusiasm that echoes previous technology bubbles. They see geopolitical tensions that could disrupt the relatively stable conditions that supported the long bull market. They see all of this, and they are selling. The question for every American investor is not whether you can time the market perfectly. You cannot. The question is whether you recognize that we have reached a moment where risk vastly outweighs potential reward, where the mathematics of valuation strongly suggest disappointing returns ahead, where the accumulation of economic and fiscal problems admits no easy solutions. The billionaires have answered this question through their actions. They are choosing preservation over speculation, patience over impatience, safety over reach. They are building cash fortresses to weather the storm they see forming and to capitalize on the opportunities that chaos inevitably creates. They are, in short, preparing for what comes after the music stops. The only remaining question is whether you will do the same, or whether you will dance until the very last note, believing that somehow, this time, the song will never end.